Welcome to TheoTrade. This is Don Kaufman. It's April 4th, 2025. Just about 30 minutes to go to the cash close on what can only be described as an absolutely epic trading day and trading week. Markets, well, look, you're watching them descend right into the eye of the volatility storm. I mean, literally live as I speak here. S&Ps are down some 5%. We're off the bottoms of this marketplace. There's a lot of fear coming into the cash close. Anything is plausible, but I have considerable concerns coming into today's cash close. And I'm going to tell you, normally on these kind of weekend updates, I'm pretty guided and go right at it and hit some bullet points. But today's session, obviously, this is rather unique. One of the things I'll mention before I even dive into anything here on the weekend's update is just coming into today's cash close. There's a lot of people that are pretty unhappy with some of the moves they're seeing inside of the marketplace. And there's going to be the possibility of heavy redemption selling. If not even necessarily today, it's still going to be a little bit of a hangover into Monday. And what redemption selling is, that's predominantly retail. It's mom and pop, like a 401k, and they're bailing out of some of those mutual funds. And what the mutual funds do throughout the course of the day is they add up all the redemptions, but they have a cutoff during the day. So they're adding up the redemptions and adding up the redemptions. But you come into that last like half hour to the close, and there can actually be, for instance, 50 million at this firm and 100 million to sell at this firm. They could hit this marketplace into the close. It is a real possibility. All right, let's push past redemption selling. Look, if you're not going to see it today, you're probably going to see some of it again, a little bit of a hangover into Monday. And you need to be a little bit concerned on that front because retail order flow is critically important, and it'll actually drive institutional order flow. And that basically what it means is if retail sells, the institutional side of the business just dynamically trades with it, meaning that retail is selling, the institutions are going to sell into it as well. That does not, completely eliminate the possibility of a rip your face off rally at any point, but it just leaves on the table, a tremendous amount of risk. All right, let's get into it here. As I was saying a moment ago, you're seeing markets kind of descend into the eye of this volatility storm. One of the first things that I want to look at, just forget where the S&Ps are for just a moment. We're actually going to cruise over to the SPX. When I start looking at the SPX, one of the first things I do is I bring this up on this is just a 9-month chart, but you got to start to bring this up on a 5-year. And the reason you want to bring this up on a 5 years, you can see my chart looks all marked up over here. It's okay. Don't worry about it. I just want you to see the significance of this move right now, that this 1-day move, the last time obviously that anybody's seen anything like this in 2022, we had a bit of a bear market, but I'm actually going to cruise over to the spiders, and I'm even going to open up a 15-year weekly. The last time you saw this kind of violence to trade, right, would have been during the COVID crash. 2022 did not have this kind of, if you will, violence to it. Obviously today being an absolutely critical standout, in terms of trading sessions. Markets maybe got a little bit of a bid under them here, but let's not start high-fiving one another just yet. Okay. So as you look at this, it is what we term kind of a 3 sigma move. And, to throw some statistics out, who cares? No, you should. You should care, because this is what we would look at as a statistically significant move. Long story short, you can, look at this and say, wow, some of the worst, okay, has got to be behind you at this point. That's the rationalization. It's actually why I put that in there. It doesn't mean that we can't descend lower. Don't worry about the chart. Like, it doesn't mean that we can't descend lower. It simply means, okay, you know, the most horrendous portion of this, the repricing, okay, is definitely behind us. We can still descend lower into the pit of doom, but that repricing, the shock, the volatility shock, okay, is now in the rear view mirror. And that is important. Okay, so the 3 sigma move and that's type of like statistical significance, it's just so important because that's where you want the bulk of the risk is in the rear view mirror. And that's exactly, okay, what we're seeing right now and why I'm mentioning this. Now, the next comment here, not exactly a positive one, but enter the bear. You know, the headlines this weekend everywhere are going to be, you know, markets descend into a bear market, right? Okay, newsflash, doesn't matter. We don't need the label, okay? I just want to move past it. Volatility is just that, it's volatility. I don't care that anybody says, well, there's, you know, from absolute high to low, okay, it's a 20%, okay, who cares? Who cares at that point? Is that going to make you, you know, better in this market? By the way, in the spider is only 17%. The bear market they're going to start calling is going to be in the NASDAQ, right? So in the NASDAQ, if you actually look from the high, okay, to where we're presently trading, you're over 20%. So the NASDAQ's in a full-fledged bear right now, okay? That's not going to make you better in any way, shape, or form. It's not going to help you in any way, shape, or form, okay? Move past it. And then the reason I say that is, well, it's good to know we're in a bear market. Look, newsflash, everybody recognizes that, right? The markets actually have fallen considerably, as I said, though, because of that big, wild statistical move this week, okay? The worst portions of the risk are in the rearview mirror. But at the exact same time, okay, the rationalization that we're going to absolutely unequivocally have more volatility is important. And you got to know that that's how we're going to produce degrees of profitability, right? Moving along. Correlation in the S&Ps. One of the things I've been talking about incessantly since the sell side activity started. You watch any video that I've done over the last couple of weeks, literally since the sell side started, any one of those videos. What do I talk about every single time? Without correlation, there is no capitulation. Guess what? We're home. There is huge amounts of correlation. That's the S&P 500. I prefer to look at the S&P 100. This, people, this is a quintessential all down day. This is a full court press to the downside. Okay, there's nowhere to run to, nowhere to hide. But what's even more interesting about, okay, this, you know, the 5 or 6 stocks that are up, they already took the hit. They are in a bottoming formation. You got Ford, okay, you got Home Depot, all right, which is amazing. You got Nike. I mean, Nike, you're like, oh, I think should be getting absolutely killed. It already did. The tariffs already took, okay, their heat, and it's, again, we're through it. And the reason I'm showing you this is because these are some of the underlyings like Target and Lowe's. This is not defensive stuff. This is not defensive. You want defensive, go look at smoke, okay? Smoke, like Home Depot is not smoke. Go look at like Philip Morris. Yeah, you would think something like Philip Morris, like smoking or drinking, okay? In the end, what? Look at this, even Philip Morris is getting killed. But you are seeing some stocks, okay, that have possibly hit, okay, somewhat of a bottom in here. That is huge, because what you need to have happen, first of all, correlation, and we're home. Correlation unto itself does not designate a bottom, but you need it to get there, period. And I've said it again, every single video that I've done over the last couple of weeks talking about correlation, and we're home. What it also takes, okay, is fear and loathing, okay? And we are also there today. I mean, I'm going to be very forthright in saying, okay, I've been doing this since, the fall of long-term capital management was my first summer trading, okay, 1998. All right. And look, every time that we've actually hit, okay, a significant volatility patch, you got that hit in like the bottom of your stomach. Some of you, you have trouble sleeping and so forth. Yeah, we're there. Okay, we're definitely there. Look, I got woken up by alerts. I've been up since 3:15 this morning. Okay, looking at markets. I got alerts right here after China actually retaliated on the tariffs. It is what it is. And speaking of tariffs, I am going to speak just briefly on tariffs. Like, I don't care about the politics behind it. The bottom line is we're going to trade through it. We're going to invest through it. Okay, it is what it is. And I'm not here to tell you, whether it's good or it's bad, but I am going to tell you this. Okay, what you are seeing in markets right now, it's not about tariffs anymore. It's about a fundamental change, okay, in economic structure, not just in the United States, but the entire world. The whole world, like, this is economic disruption. It's kind of like, a couple of years ago, you would hear about, oh, this technology company came out of nowhere and it disrupted, okay, what? I mean, think about how many companies have been completely decimated, okay, from disruption. Well, it doesn't matter whether you like tariffs or not. This is an economic, okay, disruption. How it's going to turn out is a whole different story, but it's an economic disruption. And what you're seeing inside of the S&Ps, okay, it's almost like the Matrix kind of fighting back a little bit. It does not like it because the unknown is how the economic disruption is going to play out. And at this point, we're just floundering, trying to grasp onto anything we can, okay, to figure out what's this going to look like, in the next year for somebody like Apple, okay? It fundamentally changes the way that they do business. They may be vulnerable to disruption now. That's how fast, okay, the world can change. But when you start looking at this, okay, these are rallying. They're rallying, okay? Everything in tech may have actually crested and hit bottom. And that's why I say it. Fear, okay, is what it takes. Understanding that there's fundamental change underway, all right, is also a critical portion of this. But once the markets, okay, accept that logic of like this just fundamental kind of repricing, all right, so we're going to live in a tariff world right now, okay? That's it. That's it. And they're going to actually find, okay, a price point. Like, look around though at big tech. They're not hitting new lows right now, okay? Not, like all your big tech stocks, they're not on the driving edge of this, which is actually going to bring up a couple of other big problems right now, okay? So as I said, 3 sigma move, okay? This is kind of a positive thing for markets because, again, it puts the worst of the actual day-to-day moves behind us. Enter the bear market, I could care less. Correlation, you need it to actually form some degree of a bottom. Fear, okay? Fear is completely subjective. But I'm telling you from where I sit, okay, and I don't mind saying I have been through hell in a handbasket, okay, in terms of fear. And people like may not understand that comment, but I was an executive at a major brokerage firm in 2008, okay, where we had over $400 million evaporate in accounts in a matter of minutes because of some of the volatility. All right. And it took every one of us to manage risk through those times. Like, I've seen it. This is what it feels like. And it's a similar feel. Like, I'm not comparing this to the financial crisis, okay? But it's the same feel. You're like, you're kind of awake, kind of alert. And even if you're not positioned in this, okay, even if you're not necessarily positioned in this or positioned for it, you still totally get it. You're like, holy crap, like, I get what he's saying. Even if you had no positions on, you can feel it. And that's what it feels like. That fear, again, is what it takes to make the bottom. All right, moving along over here. The US dollar. The US dollar, right when the tariffs were announced, precipitous drop. Today, wild. Okay, an unrelenting bid back. There's a little bit of sell side inside of the dollar right now, okay? But it's a monumental move back. And this one is also, this is a little more disconcerting, okay? So along with the idea of that fear, the US dollar is being bought. It's a hedge. This is a hedge. And this is where, a lot of people are like, all of a sudden different sovereignties are very anti-US right up into the point where they started buying the US dollar. And I want you to think long and hard about what I just said, okay? Because in the end, our dollar, it doesn't matter what you think, what sovereignty you're in, okay? Our dollar is the only place you're going to go. Where else are you going to go in terms of currencies? You tell me, where are you going to go? I'm going to go to where? The euro? Okay? No chance. Okay? They can't get out of their own way. And I'm not trying to pick on anybody in Europe, okay? But if you haven't looked at European, the ECB, okay? That place is, it's just fundamentally broken. Nobody's going to the euro for protection. They're just not. They come to the dollar. You're not going to the Chinese yuan. You're not going to a Russian ruble because, it's illegal. There's nowhere to run to, nowhere to hide. And today, okay, when the real selling broke out, they started running to the US dollar. That, okay, is scary, but at the same time, that's what you want to see. Again, it feeds into this idea, okay, of the volatility storm and degrees of capitulation, right? We're going to be watching the dollar very, very carefully, though, in days to come. Now, this is also some of the more disconcerting areas. Oh, hold your breath when I pull up this chart. This is the energy sector. And the energy sector, even on a 5-year weekly, okay, inflicting some fairly serious damage. Obviously, oil, some fairly serious damage. And in the near term, you can see oil kind of collapsing down. These, okay, are wildly deflationary. You're in a catch-22 here because everybody's like, tariffs are inflationary. Tariffs are inflationary, okay? If tariffs are inflationary, why is oil collapsing? Because there's an economic slowdown. There's going to be an economic slowdown, okay? If you don't believe in a recession, you better start believing because the interest rates are saying it too. Interest rates have actually collapsed down, right? So on the 10-year right now, we're dropped basically to 4%, okay? So 4% in the 10-year. Then you actually shift gears for a second. And you shift gears and go from that, and you start looking at other asset prices, and you're like, wow, it's an interesting point. It's actually beyond what people are going to call stagflation. This is actually, okay, deflationary, disinflation, deflationary, whatever the hell you want to call it, okay? You are right now slipping very, very rapidly, okay, down a slope, and energy points exclusively to that. Okay, global economic slowdown. Look at any other point in time where we've actually seen, okay, energy move as dramatic as it is, and that, okay, is the root cause behind it. Now, one other one, very disconcerting, the financials, okay? Even though I was pointing out moments ago, there's some bottom fishing almost going on, maybe in Amazon. Still down, but only 1.5%. Kind of feels like maybe some of the tech stocks, as I said, are bottoming. The financials, they're getting absolutely annihilated. Now I've got concerns because when it comes to financials, and I'll give you an example. Somebody like Goldman Sachs, okay, they clear a ton of hedge funds. What that basically means is a Goldman Sachs, okay, when I say they clear hedge funds, they actually hold the positions, tons of hedge funds. This kind of volatility sends somebody up in flames. And if it does, okay, some of these financials are going to be left holding a very large bag of risk. You want to watch this into early next week, okay? Because any market crisis can rapidly become a financial crisis. I'm not saying we're dropping, it's 2008. No. Okay. But but any market crisis becomes a financial crisis, because if somebody actually loses more than they have with their clearing firm, okay, who's left holding the bag of risk? Goldman Sachs. And unequivocally, the people that work at these firms, they see the risk. They talk to other traders about the risk, and that risk is worn like a badge of honor. Like if you know that you're Morgan Stanley, we're going down. Okay, if Morgan Stanley has a serious risk issue, they'll go out there and do things like buy puts in Goldman Sachs. It's that wild. Okay, they predominantly use like, swaps and different derivatives to do it. Some of them will buy puts in the open marketplace. Okay, so that is a real fear. Energy is pointing towards a recession. Financials, the rumblings, okay, of financial troubles are ahead. To confirm that, I took a look at junk. Okay, junk's getting hammered a little bit. This is actually junk bonds. It's just, again, what it points to is just stress in the financial system. But when you start looking at junk, like on a 5-year, this is a blip on a radar screen. It's nothing in comparison to what we saw in 2022, but it's a start. As I said to you, okay, the worst of the volatility shock is likely behind us. It doesn't necessarily mean that we hit bottom yet, okay? But the worst of that 5% moves and 8% moves, okay? You're having right now a fundamental repricing of markets. And it takes time to figure out exactly, okay, what that's going to look like. And when it does happen, okay, it cracks volatility wide open. With me for a moment, take a look 7 days out. This is next week's expected move inside of the SPX. Okay, it's even hard to fathom that this number, okay, is relative, but we are looking at about a $300 expected move. Now, we just came off of a week that $144 expected move. We moved approximately 3 times that. Earlier this week, I was watching the markets. They were 57.11, right about the time the Trump administration was speaking. Okay, here we are, 51, okay, 17, some wild moves. But next week, okay, it's about a $300 expected move. And I said about, normally when I talk about expected move, it is the end all be all of risk, okay? But I am going to tell you this, that number is going to be fluid. It's really hard in the midst of like a fundamental change in the marketplace to try to pin down what risk really is. That's exactly why assets are freaking out, okay? In summation, okay, of this entire weekend's update, by the way, okay, before I get to that summation, as I said, I'm going to do this a little fluidly. They're coming in and they are selling the close, okay? We are coming in and we're going to sell this close. And you're like, oh, how could that be? Of course, it's redemption selling. This is mom and pop that whacking their mutual funds left and right. They're out of their 401ks. Do you blame them? Probably not. In the midst, okay, of this fundamental change in the marketplace, you're going to come in next week, okay? There's going to be fear. There's going to be loathing. People, this is when the opportunities open up. In the initial onset, I haven't sent that many trades to clients. I mean, today I've got like 9 orders, 9 fills, definitely sold some stuff, okay? Sold some premium in here. I haven't traded that much today. I don't mind saying that because this is like trading, okay? It's like running in traffic at full speed. Like, you're running on a freeway that's, 12 lanes across. That's what this is like. You're gonna hold back a little bit, okay? This volatility is cracking the efficiency of a marketplace wide open. Things are wildly inefficient right now, okay? You don't believe me about inefficiency? Need only look at the SPX. How does that happen? Well, we're expecting a $144 move, but no, tried for the corner and missed. It's what? It's 3 times that. You start getting 3, 4, 500 point moves inside of the S&Ps. Again, it's a fundamental change, okay? And that fundamental change is going to bring with it, okay, a whole lot of P&L. Everything, and I do mean everything we have thrown at this marketplace in recent sessions, all the trades that we're doing here, okay? Things are working. They are working right now. P&L is flying. It's not just because we're bearish. we have the right strategies presented for this marketplace. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.